Good afternoon, guys. It is echoey in here. Let me just sort that out. Hopefully that is more like the thing now. Okay, so it is 1:45 p.m. on Monday, the 26th of February 2024, and you're very welcome along to. I think at this stage we are a year and 47 weeks into what is anticipated to be a 8-year fire journey. I'm using a slightly different setup this afternoon, and if I sound a little bit different, it's because I have got the sound coming through the microphone that I'm using. Anybody that does streaming on a semi-professional basis will probably know what I mean, and basically I can hear myself. I can even hear myself breathing, so it's a little bit novel, a little bit going to take a little bit of getting used to, but actually on the whole I think it's probably no bad thing. Let's have a look at the market. I think it's not quite a week since we were last here. This is the only day that I've got free this week, and that's why we are doing the broadcast today. So as you can see, a fairly steady climb in the upwards direction over the past, well, that's from October, so what's that, about 4 months roughly. If we short things down a little bit, you can see that in essence this growth is kind of trending towards finding a midway between where I think fair market value should be and where we have been. So I'm not actually worried about that at this present time. That's not to say that when I do see a little bit of a pullback, I do find that slightly reassuring. But as you can see, for the most part, these candlesticks are generally of a pretty uniform size, and I think that's no bad thing at all. Nice, consistent, steady growth is all to the good. If we look at the actual figures themselves, we are currently sitting just under 14,000 in the portfolio, with a return on investment just over 2,000, or 17%. The current market price £76.17, current average 64.72, and actually for the day the market is actually down 0.1%, but as you can see the rest of the figures are in the green. Let's have a look at the notifications briefly. LI Auto, I don't know if that is supposed to be Lithium Auto, but up 13%, strong quarterly earnings growth amid robust car deliveries. Warner Brothers Discovery dives 9% after Q4 earnings miss. Berkshire Hathaway, LI Auto, or Li Auto, whatever way you say that, I nearly said Biocyst, BioCryst, Pharmaceuticals, Domino's Pizza, Cosmos Energy were biggest stocks before earnings there. MRVI, Maravai Life Sciences rallies 55% on surprise Q4 profit and strong revenue guidance. Okay, so that's a massive jump there. LUNR, Intuitive Machines, soars 15%, becoming first private firm to land a spacecraft on the moon. Presumably that's all over the news. I don't know, I haven't watched it, but I would expect so. Carvana up 40%, soaring to a 2-year high on first ever annual profit. SQ expects growth, so Block soars 15.5% on strong 2024 outlook, citing consumer resilience and cost-cutting measures. And finally, Standard Chartered up 8%, announcing $1 billion buyback alongside strong earnings growth. So those are the notifications, and we were last here on the 21st. This is now the 26th. So yeah, a couple of days shy of the full week. But as I say, nothing much I can really do about that. I have to take the opportunity when I have it. Guys, as you can see, the market is open. Let's go ahead and put in our weekly investment, and as usual today we will be purchasing 120 theoretical pounds of the S&P 500 exchange traded fund, seen here on the Trading 212 platform. Vanguard, because they historically were the exchange traded fund provider with the lowest fees for management. We're going to be buying roughly, was it 1.5 something shares there. I didn't notice it myself, but if you were observant, you may have seen the green line move a little bit. The average price will have changed slightly, and as the figures have updated here, I can see that we now have just over the 14,000 in portfolio value. So all kind of looking pretty good at the present time in the market. This figure of 21% is not a surprise to me, basically because when historically there has been a crash in the market, that crash is normally replaced within 24 to 48 months with a strong recovery, and in the kind of period of the recovery, it's not unusual to see annual growth in the S&P 500 at least of between 20 and 30% per annum. So that, as I say, that figure, not a surprise in that context. It could go higher, just depending on how things go. If you remember back to this period here, there was a lot of basically up and down volatility, and I suppose depending on whereabouts on those peaks and troughs the market happens to land in its comparison for this time a year ago, you could well see a significantly higher figure perhaps than 21%. But yeah, so far, as I say, we're not even 2 years into this investment journey. Already it is looking profitable. I don't think on the practice platform we can benefit from dividends in the same way that you can in real life. And some of you may have heard of such a thing known as a DRIP. if you've looked into investment a little bit. Basically what that stands for is a dividend reinvestment portfolio, and that's essentially a portfolio where depending on what you have chosen to put in it, you may be able to get frequent dividends, and then just simply reinvest the dividends and hope for exponential growth because of the reinvested dividends. It is one method of investing. I would imagine it should be quite a successful method for investments in real estate investment trusts, but really only when the real estate market is performing normally, and I think at the present time, I think that's not the case. From the REITs that I have been following separately outside of this channel, it looks to me as though at the present time the housing market is still not really recovering. I am seeing some signs of some dividends being paid, but on the whole, I feel as though the housing market still has a long way to go before we can even consider that it is anywhere close to recovery. But yeah, I may have mentioned before the logic behind the investing that I'm doing here is thanks to J.L. Collins, Jim Collins, who wrote the book The Simple Path to Wealth. Let me just see if I can look that up for you. Pretty quickly. It's a book that's available on Amazon and elsewhere typically. I'm not sure what that is on Etsy there, but it looks as though there may be a version of it available on Etsy for really pretty cheap. There is the Amazon one. Let's have a look at that. Just to see what the current price is. Oh goodness. I don't really understand why that seems to be so expensive, other than the fact that J.L. Collins has maybe become more famous than he used to be. That's showing their paperback for £35. Hardcover from 23.10. Other used and new from 23.10. Kindle edition £7.01. I didn't pay anything like that. I paid about a tenner, and that was for a paperback copy. I don't understand why that's so expensive. Let me just see if there is. It may just be that there aren't a lot of there maybe not a lot of offers for that at present, if you see what I mean, and therefore people are trying to cash in that way. Now here is this is a digital download. Okay, so this is actually described as an executive summary for The Simple Path to Wealth. which is not the same thing. That's kind of like somebody reviewing the thing and trying to pick out what they think are the salient points, I think. But yeah, I mean, look, as I say, there were other offers there for the book. W.H. Smith was 18, Waterstone's 18, eBay 16. As I say, I bought it for a tenner. And quite frankly, you know, there's his website, jlcollinsnh.com. So jlcollinsnh for New Hampshire.com. And as he has said in many interviews on YouTube and elsewhere, basically he decided to write a blog to record what he felt were important ideas or methods of investing, if you like, for his daughter. If I remember rightly, his daughter is Jessica. And at the time that he had wanted to impart his knowledge, I suppose, he felt that Jessica either was too young or too distracted by other things to be able to take in what he wanted to pass on. And hence he had started the blog that you see online here. I think it's the stock series. I think there's that perhaps the part of the site that everybody refers to. So as you can see, there's lots of different parts to it. I'll be quite honest, I haven't actually read through the website, and that is the truth. But as far as I can tell, and from what I've heard, everything is there. There are no secrets, there are no backdoors with J.L. Collins. All the information that you need in order to replicate what he regards as the simple path to wealth is contained within the pages of the website. And it's nice to have the book. No doubt it is nice to have the book, but it's not an absolute essential. Now, in addition to the S&P 500, J.L. Collins would say that you should also counterbalance that with bonds, okay? Because typically bonds will rise in value when the stock market is performing less well, and vice versa. And the statistically recommended mix of shares and bonds, or ETFs and bonds, is roughly 60-40. However, personally speaking, I don't have access to bonds through Trading 212. I don't really understand bonds. I don't understand the bond market. I mean, I've read a bit about them, and I feel a little uncomfortable with them, to be quite honest. I don't particularly like bonds as an investment vehicle, if you like, because even when bonds do rise, they generally only rise moderately. So with that said, I personally have chosen not to make use of bonds to counterbalance my S&P portfolio, but on the other hand, I have got some investments in real life, in real estate investment trusts. And as I say, at the moment, the REIT market is just not where, well, certainly not where the S&P 500 is, let's put it that way. I currently am in the red with my REIT investments, and that's pretty much across the board. And to give you a little more detail than that, I have one basket of US REITs and another of UK REITs. I think the reason I split them like that was so that when I wanted to either rebalance or whatever, then all the REITs in the basket would be able to be rebalanced simultaneously, because obviously anything that's UK based is going to be available to trade during UK market opening hours, and vice versa for the US. But yeah, no matter whether you look at the American ones or the British ones, pretty much across the board, the whole of the REIT part of the portfolio is currently in red. And as I say, I feel that there is optimism to be had with regard to REITs. There really should be a good solid investment into the future, and that is why I have chosen to go that way as opposed to going into bonds. But you could disagree, and if you do, why not leave a little comment in the comments below, and I will happily read them and indeed give you feedback on that if I feel it's appropriate. Guys, that is going to be it for today. Thank you for watching. If you enjoyed this particular video, why not give it a thumbs up? And if you're interested in following the journey as a whole, please consider subscribing to the channel. That's it for now, and have a great end to your Monday. Thanks for joining me.